Hey, Bulls and Bears, we're back with another dose of economic reality. We have new evidence that big trouble is headed for the U.S. consumer, and it's not going to be pretty, folks. Hope everyone's doing well here. I should say it's not going to be pretty because for probably most of us here, it'll be just fine. There's a lot of people out there predicting doomsday scenario, and some people think that I predict doomsday or a crash and everybody's going to starve. I haven't predicted that. Now I've quoted other people that have predicted that. I don't see the markets imploding unless some big event happens, a black swan event, for example. So it could happen. It's possible. I encourage people to be prepared for something like that. But most of us here will be prepared very well because why? Because we saw this coming 100 miles away. We've been talking about this for a long time, and now the rubber's meeting the road, and the U.S. consumer, which is the backbone of the U.S. economy, is in big, big trouble. So without further ado, let's go ahead and get into the numbers here and the stats, and I want to share information and charts as usual here since we're doing the screen sharing here lately on this channel. And let's bring this chart up here first. And let's take a look at total consumer debt. And remember this number, basically 17 trillion, 17.3, and it's likely higher. This is as of the end of the third quarter. Just wait till the fourth quarter numbers come out. It could be at the pace that it's growing, it could be 17.7, maybe even 18 trillion dollars. So just remember between 17 rather and 18 trillion dollars. And let's think about that. 17 and 18 trillion dollars in debt. Now, let's look at how much savings the US consumer has. Now, this is an article that came out earlier in the year here, 2023. I can't really find a more updated one, but it hasn't went up much. In fact, it's probably went down since then. Total US personal savings, $802 billion dollars. Think about that. $802 billion dollars collectively US consumers have saved, less than 1 trillion. But yet we're supposed to pay off between 17 and 18 trillion dollars in debt. So then what you might be thinking is, of course, people don't have that much cash or savings because a lot of their wealth is tied up in their homes. It's in their retirement accounts, 401ks, and other assets and investments. Maybe it's in stocks. Okay. So sure, you can make that argument. But how are people going to pay off 17 or 18 trillion dollars in debt? First of all, with less than $1 trillion in savings, that's obvious. But if they have these assets that are worth a lot of money, what happens when everybody starts selling their assets in order to pay off this debt? Prices collapse. When you have a whole bunch of sellers sell their homes and their assets or their stocks, then you're going to see prices collapse because you have so many sellers on the market and not enough buyers. So that just shows you how this whole economy, this whole financial sector, financial system, if you will, is set up based on a Ponzi scheme type of scenario. Oh, we are lit up, by the way. Happy holidays. Welcome to December. Today's December 2nd. Did I put out a video yesterday? Not sure. Well, I did. I did put out a video, but I recorded it the night before, which was November 30th, because yesterday was December 1st. Today's the 2nd. So I didn't actually record it on December 1st. That's why I didn't have the lights up. So hopefully it's not looking too crazy back there. Hopefully it's not too much of a distraction, but I like to be festive here. Oh, but actually, I should have read the next line down because it talks about this excluding retirement assets. The average American has $65,000 in personal savings. Now, keep in mind that includes multi-billionaires, all averaged out, right? So you have people with hardly any savings, people with billions of dollars in cash and savings. When you average it all out, $65,000. But a lot of that is concentrated up in the top 10%. Remember, it's the top 10% that owns close to 90% of all stocks. And, it's very unbalanced right now as far as the balance of wealth for the top 10% compared to the bottom 90%. All right, but it gets crazier. Let's go over some other numbers here and some data here. In our previous report, December 1st, yesterday, we talked about the housing market, and I made my prediction on what's going to happen in 2024. If you haven't checked out that video, please check it out. December 1st video. But take a look at this. This is a chart of owning a home versus renting. And we've never seen it this unbalanced. So basically, as of the third quarter, 52.1%. So basically, you're paying over 50% more to own versus rent. And that's a new record, right? So with the higher rates, even though home prices haven't went up that much, but look at compared to 2000, what's this, 2005, 6, 7 is where it peaked out. We actually saw the peak there. Looks like mid 2005 if you're looking at my my pointer right here. If you're looking at my arrow. So what does this tell us? This tells us that we're in a bubble way beyond the previous bubble. And it also can give us a timeline on when we may see a correction, right? So if the rate back then, financial crisis, pre-financial crisis, if it peaked in 2005 and we didn't see the housing bubble bust until 2008, well, what we have to do is continue to watch this number and wait for it to peak. When it starts coming down, then you know we're near the point of where the correction begins. Now, technically, you can say the correction has already begun. If you look at real estate, we see prices starting to come down now. We're below the peak. Now, we're still up year over year, but we are below the peak. And we also, in our last video, talked about how inventory is starting to climb now year over year. The first time that's happened in about close to 7 years, right? So things are changing very slowly. A lot of people expected things to reverse or start dropping a lot more quickly than they are. So why is it so slow this time? Well, we had a lot of pandemic savings. The thing about that, though, people have, for the most part, used up their pandemic savings, and now we're close to near all-time lows in consumer savings. And you look at the total consumer savings versus the debt, it's impossible to ever pay off. The whole system is basically designed to fail, where you create money out of thin air at the click of a mouse. And that's why you have to be well positioned here and positioned, I think, smartly. And I think most of us are. Now, people have been asking me about silver. When's silver going to take off? Remember, silver is a long-term play, a long-term play. I do believe at some point we're going to have to go back to some sort of hard assets, some sort of metals-based system. And it doesn't mean you're going to be carrying around coins and pieces of metal in your pocket. I think it's going to be digital in the form of our transactions. You will still have cards and you'll still make online transactions with your phone, but the actual supply of money available is going to be limited to the amount of precious metals. I think gold and silver both at some point will be integrated into the system of money, into the monetary system. And that's going to get rid of this outrageous cost of living. We won't see these price bubbles. We won't see this outrageous inflation. Now, it could be still a few years away. That's why when people ask me, should you invest in silver? Well, it depends. If you have extra money, yes. That's why I say keep stacking. Stack as much as you can, as often as you can, is what I say. But if you're struggling, living paycheck to paycheck, and I've been there, believe me, I've been there. And but if you're struggling and you're thinking about buying silver versus paying your rent, don't do it. If you're thinking about buying silver versus paying your light bill, don't do it. So you want to still maintain some standard of living, but if you have extra money that's not going to impact your standard of living, then by all means, I would, if I were you in that position, I would be accumulating some precious metals, and especially silver. I think silver is very undervalued. Right. So that's my stance on that. People were asking about that. So what's December going to look like? Well, some people have been saying I've been predicting a stock market crash. No. It's just the opposite. If you watched my videos recently, I predicted a short squeeze and possibly markets even going to all-time highs at this point. We have traders right now, investors are very optimistic about the end of rate hikes. Very optimistic about that. Now, the Fed hasn't went out there and said they're going to cut rates. I should say Jerome Powell hasn't actually said that, but we do have people at the Fed. We have Waller at one of the central banks, the Fed banks, saying that rate cuts are very likely at the beginning of 2024, as early as March. Right, so we have these conflicting voices within the central bank. Um, so it's a very interesting time to see what investors and what traders are doing. But there's a lot of optimism nonetheless. We had a massive November in the stock market, and we have gold. Gold starting to take off over $2,000. It's actually $2,091. Let's take a look at silver. Silver closing in on $26, folks. So precious metals are looking really, really good. Bitcoin, 38,700 approximately. All right, so we have some investments on the move, and I hold some of all those that we just ran off there. So that's the thing about this. I mean, you still want to be invested. There's some people sitting in all cash right now, hoping, praying for some crash or deflation. Folks, if that doesn't happen, you're going to be missing out on some gains here in some of these investments. And I told you that I'm shorting the retail sector. I'm not shorting the stock market as a whole, but I am shorting the retail ETF because I think retailers have peaked. Why? Because consumers are, for the most part, tapped out. They're not completely wiped out. They're not completely without savings, as we just talked about earlier in this video. But I think as the inflationary pressures continue to mount on U.S. consumers, you are going to see some impacts in the overall economy. Now, keep in mind, when I say the economy, I'm not talking about the stock market. We have two different things here with the stock market compared to the real economy. The stock market is not an indicator of the average U.S. consumer. We have between 60 and 70% of people living paycheck to paycheck. Back to what I said a few minutes ago, remember, the top 10% own close to 90% of all stocks. So when the stock market goes up, yes, some people are making gains in their 401k, but it doesn't mean they have spendable cash, right? Savings are being depleted. We're going to see the holiday season here probably break records again with people running up more debt than we've ever seen before. It'll break records again. When we see the end of the year numbers, we have less than a month to go. And it's my guess we're going to see another record amount of debt being accumulated by U.S. consumers. And where does it end? Well, that depends on the banks. If the banks are still able to loan out money that they don't have, you see, money is created by banks. When banks make loans, mortgages, loans, when they loan out money, when they give credit on credit card lines, lines of credit, that's how money's created. It's no longer just printing paper bills out of a printing machine. It's actually banks creating money by giving out loans. That's how money's created. That's how it's put into the economy. Of course, in some cases, you have checks being sent directly from the Fed or from the Treasury, rather, like we had the stimulus checks a few years ago. So those are the different ways that money's put into the economy. But think about it, even a check is not printing $100 bills or printing bills. It's still just out there in cyberspace somewhere, basically, because when you cash the check, are you getting coins and dollar bills? Well, no, most people are just getting digits put into their checking account, right? So that's what all this is, folks. It's digital money right now, mostly. And that's why we see inflation very, very high and not coming down. We still have banks out there loaning out money. Banks are actually fighting against having any reserves in their accounts. They want to have zero money or zero cash in their accounts or zero cash held in reserves to be able to continue to make loans. So until that changes, until we see some sort of fallout or some sort of change in the banking system, the way money's loaned out, it's very unlikely we're going to see a crash. But if you look at the consumer is not flush with cash. The most of the spending is basically people borrowing money. Most of you know this, so you've got to factor in the good chance of deflation coming down the road, but I wouldn't be in all cash right now. Just my opinion, what I'm doing. Of course, do your own due diligence. Everyone's situation is different. Don't take advice from me, but take this news, analyze it, and do what you will with how you're going to plan going forward. All right. So hope everyone's doing well. Thanks everybody for being here. We're going to wrap this one up here, and we'll be back with another update as soon as possible, ASAP. Thanks everybody for being here and for watching. keep stacking, invest wisely, and we'll talk to everybody very soon. JJ here, Bull Boom Bear Bust, out.